Then we get to confirmation of direction. Guys, again, technicals is a visual interpretation of what's going on with an instrument and its price. Okay, so quite easily we can see visually that the trend is bullish or upward moving. This is what we want to see when we want to get into an investment. I don't like to see downward trends when I'm investing because over time I would like my investments to go up. But you do need a little bit of help to see if this trend is going to be lasting over the period of time that I want to hold it. So typically, linking a series of bottoms does give you the direction of the trend, but you also need to add to your charts what's called a stochastic oscillator and a relative strength indicator. And what these things do is give you an indication of what's happening with the momentum. What are the buyers doing and what are the sellers doing with the specific price of that instrument during this time. The relative strength indicator is this green line that I've circled, and it indicates how strong or weak the price is at this point in time. So this might be this month or this week or this year or even this minute. Okay, so the minute we start seeing an upward turn in the relative strength indicator, it means that buyers are starting to come into the price. Now, why is this important? We go back to the stochastic oscillator, which is the blue and the red line. This kind of gives you the momentum, and I will get into a little bit more detail in a few slides' time. It indicates where buyers tend to take profit or where they tend to start buying. And normally these two indicators coincide with each other, because as the relative strength indicator starts to turn up, an oversold price will start ticking up and making its way as new buyers come in. So there's two little sets of confirmations. Typically, when stocks are overbought and guys start taking money off the table, a price will tend to come down because they're selling. They're taking profit. This is by no means time for you to panic because you're a long-term investor. It is just an indication or a signal for you to know that when the time is right to get in, or if you're looking at exiting a trade, when is the best time to maximize your profits. So let's get a little bit more technical. Okay, guys, taking profits early if market conditions dictate doesn't mean panic in a Wall Street sell-off. Last week, our market wiped off about 3,000 points. Long-term investors should not be scared of little corrections like this because we're in it for the long haul, and our market averages about 16% per year that it goes up, and that includes the crash of 2008, 2009. So we do need to cut out the noise and not be scared of little corrections. But it's probably not a bad idea if you're in the capital preservation stage of your investment to maybe look at taking some money off when companies start giving you poor trading updates. That's normally a signal that that share price is probably a little bit overvalued, and that if they give you profit warnings, that this company is probably not going to be performing as strongly as it has been for a little while to come. Again, that boils down to opportunity cost. So maybe look for something else that has a little bit more promise. Or even bad economic indicators, things like a weakening economy. If you're invested in some offshore shares that might have exposure to Germany or the DAX, where you start hearing whispers of Germany might be slipping into a recession, or Europe might be slipping into a bit of a recession, it's probably not a bad idea just to take some money off the table, cash in on those stocks, wait for the market to settle a little bit, and wait to time your entry again. And you can do all of this on your charts because charts represent what prices are doing. Also, guys, strike action. If you're holding counters like mining stocks, we all know what the platinum strike did to our economy and the broader mining sector. You don't want to be involved in noise like that as a longer-term investor. So when these things start settling down, it's probably the best time for you to get back in. As soon as your charts let you know that this is the bottom and this is turning and momentum is going back in your direction, you could probably get back into a decent investment at much better prices. And just to remind you, always have a plan when you get into your investment. Set your entry, set your take profit and your stop loss level before going into this investment. And this is very important because it takes the emotion out of trading. Nobody wants to be stuck in an Anglo-Platinum trade at the peak of the platinum strike, violence, unrest, and the dire effect it has on the economy, and then not knowing what to do. A lot of my clients phone me and go, what do I do now? Now this guy that's asking, what do I do now, would never have had to do that if he had a firm plan in place right at the beginning, knowing the dangers of what could possibly go wrong, and if things go wrong, get out and stick to the plan and get into something else that's going to make you money. And this is where charts are important. So here's some technical tools for you guys just to get you on the right track. We're going to look at support and resistance. I've touched on the stochastics, the moving averages that are most important, and I think there's only one as a long-term investor that we need to touch on, and the trend, which I've also touched on.